Hello, I'm Chloe Cho and welcome to Investor Insights. It's been less than 2 weeks since the shock outcome of Brexit, yet it's fascinating how risk has been back on with global equities flirting with record territory while bond yields have been falling. Is this the calm before the big storm? Here's a look at our headlines.
Easing signals abound post-Brexit as major central banks, led by the Bank of England, consider accommodation and even interest rate cuts to counter the potential economic risks from the period of uncertainty. An inconclusive outcome from Australia's elections raises the prospect of a hung parliament. Is an RBA easing a done deal next month as questions emerge over the risks to Australia's AAA credit rating? Plus, expect 4 more cuts in Trading Talents Asia Pacific as top 15 slim down to top 11 in the second finals week of the region's first televised trading challenge. Let's get insights from Brian Goh, Chief Investment Officer, Bordiasia, Singapore. And our judges of Trading Talents Asia Pacific, Angus Geddes, CEO of Fat Profits, and Eric Liu, Head of Research, Vonda Research. The Brexit vote wiped a record $3 trillion off the value of global shares in a 2-day sell-off. Despite the period of uncertainty, markets have recovered their losses on prospects of central bank easing and prolonged low interest rates.
The markets have reacted relatively positive to what I call the maximum intervention we've seen from policymakers since the Brexit vote. So essentially what's going on right now is a total repeat of what we saw after the crisis peaked in 2009. We have promises, we have countries fighting to get more leeway in terms of being able to do fiscal deficit. So basically the policymakers are working to the extreme to reduce the political fallout.
Traditional safe haven plays such as treasuries, gold and silver continue to rally, with the yield on the U.S. 10-year note near record lows. British gilts fell into negative territory for the first time, joining the -0 club as BOE Governor Mark Carney hinted at fresh stimulus measures. Prospects of an interest rate cut are likely to keep sterling trading near a 31-year low under pressure. The UK vote to leave the European Union has strengthened the yen, up about 8% against the greenback in June, heightening risks to Japan Inc.'s corporate earnings while adding pressure to Shinzo Abe ahead of upper house elections on Sunday.
To a large extent, that the fixed income overshoot is now done. So we are going back to a more balanced portfolio where essentially we have 25% in equity, 25% in fixed income, 25% in commodities, and 25% in real estate.
Much remains to be seen how much U.S. jobs will divert attention from Brexit headlines. In May, a paltry report with 38,000 net new jobs shocked economists, a number far below the average of 229,000 gains last year that could spell a broader hiring slowdown.
53% of the jobs being created have been for 55-year-olds plus. If you've got 55-year-olds who are working because they have to, they're not going to go out and buy a new TV.
We're looking for a bounce, but nothing too large, maybe around the 150K level. The main thing we'll be watching for is whether there have been any upward revisions to previous months' numbers as well.
Look at Federal Reserve's own broadest measure of the labor market, the Fed Labor Market Index. That is going from low to low. So I would not be surprised that we again come significantly below the expected number, which is running at a consensus of 175,000 new jobs.
While the consensus view is that easy monetary policy is here to stay for a while, Bank of England Governor Mark Carney gave investors a reality check after cutting bank capital rules and saying that Brexit is not all about stimulus. Let's talk more with Brian Goh, Chief Investment Officer of Bordiasia, Singapore. So we've been in a risk-on environment for the past week or so after all this turbulence emanating from the shock outcome. So does this mean that this exuberance is coming to a screeching halt?
What are the long-term implications for Brexit? I think nobody knows. I don't think the Bank of England governor knows. I don't think the Prime Minister of the UK knows. The politicians will take, at best, 2 years to figure this out.
So if we have a 2-year time frame, at least, on the immediate horizon. What do you do now? Do you see bonds overshooting? Do you see equities already flirting with record highs, pulling back? What are you getting into now?
The key to investing safely is to avoid all the retail money and to avoid chasing capital flows.
You think that 8 shares are reasonably valued. They're down about 10% year to date, but you also have the China overhang to deal with, the slowing economy, the weak currency, etc. And then you talk about other exotic markets like Russia, Turkey, Egypt. However, when we go back into risk-off mode, these markets tend to get hit even more severely.
These markets are cheap, but they're cheap for a reason. And I'm in no way suggesting that one go and buy these markets. For example, China. I think we've got a good handle, globally and the investor crowd. We understand the risks in China. We understand the economy of China. But nobody understands how those markets are going to react.
I'm surprised to know that you're looking at the very risky space of CoCos, contingent convertible bonds. That is getting right into the heart of the storm in Europe, where you've got bank valuations all the way from Deutsche Bank to Banco dei Paschi in Italy. Some of these banks are trading at about 20% book value, and there are serious questions about whether some of these banks can even make their coupon payments.
I like to invest in anything that's getting less risky, even if it's risky to begin with.
Isn't this the riskiest thing right now?
Well, the riskiest thing is equity. CoCos are one step senior. Right?
Okay.
The risk is that you get triggered and you become equity or you take a write down. So the riskiest part is equity, and I wouldn't buy the equity of banks. In fact, banks are being forced to recapitalize, and that means more first loss capital ahead of me. Now, what's the trigger risk? So before I get triggered into equity, certain things need to happen, and one of those is the Tier 1 capital ratios of these banks need to reach their trigger levels. And we are far from that.
But are you looking at the European Central Bank's backdrop for some of these European banks?
Not so much what the ECB is doing in QE or their corporate securities purchase program. That's for investment grade bonds, and they're non-financial investment grade. I'm looking at financials. But this is a different theme. This is a theme of regulation. The more regulated the banks, the more capital they're going to need, and also they're going to have to deleverage their balance sheets. Both of these things make CoCos safer.
CoCos might seem a lot like subprime in the US.
No, they're quite different. So subprime were bad assets, they were securitized, and there was ratings arbitrage going on. The contagion impact didn't come from non-agencies, they came from agencies because they were so widely used as collateral that they began to infect markets that were unrelated to the mortgage crisis.
How much yield are you looking at? What's your return from CoCos?
It depends on the credit quality and the quality of the bank. Obviously, if you get a very high number, you're assuming a lot of risk. But you can get 10% in UK banks, for example, in fairly well-capitalized ones, or you can get high single digits in some of the Eurozone banks.
It looks like you've got stomachs of steel. Well, great to hear your thoughts there, and wish you all the best of luck. Brian Goh, CIO of Bordier NCA Singapore, talking to us about where he is advising his clients to put money. And coming up next, we're going to check in on how our top 15 fared of Trading Talents Asia Pacific with Eric Liu and Angus Getty, two of our judges, up next. Welcome back. It is time for Trading Talents Asia Pacific, the region's first televised trading challenge. Let's take a look at how our top 15 stacked up in their second finals week.
The competition is getting tougher every passing week as uncertainty and volatility surge post-Brexit. The top 15 may have come this far after battling out more than 2,000 trading enthusiasts from the start, but 4 are facing cuts this week in Asia Pacific's first televised trading challenge.
The biggest challenges is the fear and overconfidence as a trader. Fear in the sense that if you are so fearful in trading, you don't know when to go in the market.
I think we need to be more focused on short-term intraday tradings because majority of asset class traded within a very tight range with sideways movement.
Plus, what strategies worked in their favor?
I'm using RSI for trading and also moving average. Bollinger, as well as pivot table. So all these are technical charts that actually helps you in the time to go into the market.
One of my trades was pound USD, and fundamentally I thought it would be going up, but I was wrong, so I had to cut the position.
Many of the FX pairs still traded within their tight range, so I figured out to overweight my trades to another asset class, such as equity, global index, and also future contracts.
Being on the wrong side of a trade could have easily wiped out the $10,000 balance in their live accounts with access to thousands of instruments from Forex, options, CFDs to futures. 4 finalists are eliminated this week based on the judging criteria of net portfolio value, max drawdown, judges' scores, and clout score that gauges their social media influence. Up for grabs, the grand prize of $30,000, another $10,000 for the runner-up, and $2,000 for the top weekly trader. Plus, 5 online voters voting for their favorite trading talent get to win $100 worth of e-vouchers each week.
Hands down, this is the toughest market I've ever traded. The correlations don't make sense, the dislocations don't work. Got to expect the unexpected. It's a strange market we're in at the moment.
Unless you think that you have some sort of edge, whether it be informational or an edge about how you think about the way assets will price, then it's very difficult to outperform the market consistently.
Trading alpha is about seeing what other people don't see, finding opportunities that have been overlooked.
All right, 2 down, 4 more to go. So how did the top 15 stack up? Let's find out more from our judges. We have Angus Getty, CEO of Fat Profits, and Eric Liu, Head of Research at Vonda Research. Given all the exuberance, risk-on mood out there, our contestants, our top 15, didn't fare as well. We only had Rahul and Richard, who offered returns of about plus minus 40%. The rest were far below that, only when you take a look at the portfolio value.
Yeah, I think it's important to note just how important it was to pick the right assets last week. And so the equity rally that most people are talking about was mostly defensive-led. People who were long the S&P, who were long equities in the trading challenge did very well, like Alvin, and those that decided to play risk-on via long sterling or long yen did less well because those assets responded less.
It was a pretty volatile couple of weeks. Probably saw the biggest drop in the yen, in 15 years. Certain currencies, they did very well, and I thought, there was a bit of risk management on display there as well. Tending to trade small, keep your stops relatively tight.
What is your best trading advice for the top 11? Because 4 are facing cuts this week. Eric?
Well, I think it's really difficult to make a call that's going to last for much longer than a day or two, these sorts of markets. So if you look at the really successful traders, I think like Rahul, they've been really tight with their stops. They've been really diligent in risk management. And I think that's probably the key going forward as well.
What's interesting is that Tracy, our lone female contestant, she tried something new, scalping.
Look, I think there's some really good primary trends going on in the markets at the moment. One trend that stood out where a couple of the competitors have got on board is the precious metals. Going back to your question just before, what do they look for? I think we've really got to now sort of focus on the central banks.
Mark Carney's comments were interesting. Initially, the markets thought, wow, there is more stimulus coming. But at the end of the day, they realized that what he's saying is something serious and that Brexit does not automatically equal stimulus.
But I think the big point really is that the Bank of Japan are due to come out with their policy statement. And this could sort of, signal a risk-on appetite certainly for the precious metals, put a lot of downward pressure on some of the currencies.
Your thoughts about central banks in light of how our contestants fared?
I think in the grand scheme of things, the UK vote was important for the UK, material for the UK economy, but not really for the global economy. And so where countries like Japan are facing a lot of pressure is via the capital market transmission, which is people buying yen. It becomes a bit of a circular cycle where the central bank needs to convince investors to stop these sorts of risk-off trades. I think Japan is fairly risky. If they come out and they cut rates even more, like most people are expecting, that is just going to push money out of Japan into places like the U.S.
What kind of trades would you put on?
The gold trade is probably still the most interesting. I know the trade is up 100% this year, but look, inflation is coming one way or another via the base effects. And it's really difficult to see rates rising toward the end of the year. It's boring, it's plain vanilla, but I think it's the most interesting.
And by the way, 4 contestants are being eliminated this week. We will tell you who they are in just a bit. Their issues, too few trades, huge drawdowns. Very quickly, how do you avoid these pitfalls, Angus?
Well, I think you've got to keep quite a firm eye on risk management, run a very tight stop losses. But at the same time, not jump from one thing to another. You've got to really try and look for some primary trends.
Given the compressed time frame that a lot of these guys are operating in, it's difficult to find, I guess, technical trends that are persistent enough that a week or two of volatility doesn't throw them off. It's important also just to play around with catalysts, understanding when catalysts are and getting in on trades and out trades based on when those events happen.
And let's find out who the winner of the week is, plus our top 11. Take a look.
The winner is...
Unfortunately, we've had to say goodbye to Robbie Campbell of Australia, Zachary Xu, Ryan San, and Dave Wong of Singapore.
And folks, do log on to tradingtalents.saxo to vote for your favorite trading talent. And up next, revolving door politics in Australia results in a deadlocked general election result. What are the chances of Australia being stripped of its AAA rating? We're going to talk more with Angus in just a bit. Hello again. We are back with Angus Geddes of Fat Profit. So it almost seems like a sense of deja vu. Australia experienced a hung parliament back in 2010. Now, is that going to happen again? I mean, it's a double dose of uncertainty. You've got Brexit and you've got this domestic political turmoil.
Yeah, look, it could happen. It could happen.
What are the chances?
But I think probably maybe a 20 or 30% probability. Okay. I think the coalition are probably going to get there. They will sneak in with 76. Fingers crossed. It's going to be a very close election. It is similar to what we saw back in 2010. And, you know, it's going to have significant ramifications for the financial markets and for Australia generally. If we see not so much a hung parliament, but negotiations going on with the crossbenchers and deals being done.
The ratings agencies, Fitch and Moody's, have been very clear that this could result in a downgrade. Yet there has been no shortage of buyers. When you look at the Aussie dollar, round up close to 76 against the USD, the ASX, the local property market, Australian bonds. Is this the new contrarian view trade?
Look, I think the markets are looking through the short-term noise and seeing political resolution with the coalition maintaining the status quo. That's the way I read it. And, you know, as you rightly point out about the Australian dollar, it wouldn't be rallying as much as it has. You know, if there was a good probability that the coalition were going to lose power and there's going to be deals done with the crossbench and the debt rating, compromised.
Just across the Tasmania, I heard that there's a parity party going on. Is that going to happen with the Kiwi dollar?
With the Kiwi dollar? Well, you know, it's sort of happened before.
Right.
If champagne's on ice. Look, it could happen. Look, I think if you look at the RBA and if you look at the Australian economy, we're probably going to get another interest rate cut before the end of the year.
After all, this week's RBA meeting was non-eventful as widely predicted. But so what are the chances this rate cut is going to happen next month?
Look, I think the RBA is keeping the powder dry. Glenn Stevens is stepping down, so there's going to be a transition. But certainly before the end of the year, that's what the markets are pricing in, that we're going to get one more rate cut. And that'll bring Australia's interest rates back into line with the rest of the world. New Zealand's still got quite high real interest rates, and that's why we're seeing the Kiwi outperform relative to the Aussie.
So what is that going to do to the resources plays that have also been supporting the local market, share markets?
Well, look, we're bullish on commodities, and I think the commodities have reached an inflection point, and that's going to help Australia. And certainly if we see any further weakness in the Australian dollar, which is not looking likely in the near term, you know, that's going to help a lot of the commodity producers. But even at 75 cents, you know, the gold producers are making supernormal profits with, you know, Australian dollar per ounce sort of hitting around $1,800, $1,900.
And what would be your near-term target for the ASX? What's the next hurdle?
Well, I think the ASX can, provided that we get closure on the election. I think the ASX can get 57, 5800, provided we see the, you know, the stability that's been coming through in the commodities continue. And we had a pretty good week.
Provided we don't get this resolution. The fact that Australia has been recession-proof for the past 25 years, sailed through the global financial crisis. So does that record falter?
Well, they don't call Australia the lucky country for nothing. If there is a hung parliament, if the debt rating of Australia is compromised, we may well find that Australia is staring down the barrel of the first recession in some time.
Yeah, and you're planning to raise about $50 to $60 million through an IPO sometime soon.
We're looking.
Do you think there will be, the market will be as receptive to your IPO plans as they have been to the Aussie dollar, for instance?
Well, I think if we're right on the call that the Australian market's going to go to 57, 5800, hopefully October could be quite a good month to go.
Okay, well, timing is everything in life. Well, have a safe trip back to Sydney. Really appreciate your thoughts, and we'll see you again in a couple of weeks.
Thank you, Claire.
Angus Geddes there.
Before we go, here is our question of the week. With so much talk about central bank easing this month, who will be the first to act? Certainly no shortage of candidates out there. Tweet me at Chloe Cho TV or email us at investorinsights@mediacorp.com.sg.
And that's Investor Insights for this week. I'm Chloe Cho, signing on behalf of the entire team. And for viewers celebrating Eid, happy holidays. We'll see you again next week.